Hey, this is Sasha Evdokov, and welcome to episode number 89 of Let's Talk Stocks. And today we're going to talk about the VIX, and more importantly, how you can use the VIX for trading stocks, but also options. Now, the VIX typically refers to option trading, and it's really geared and run by the options. But I'm going to share some insight with you about how to use it or use it as a gauge for also if you're just trading stocks in general. Before we get there, I want to say thank you for everyone who downloaded the book, 20 Rules for Investing Success. You can go ahead and take a look at that book on TRADERSFLY.com, and there's a Get It Now button. And especially thank you for those of you that did the customer reviews for that book. I know it takes a little bit of time and effort to do the reviews, so thank you, and I'm sure a lot of other people will also appreciate that as well as they read through the reviews to see the insight that you've gained from the book. Now, I did make this book as cheap as I could. Kindle will only allow you to go down to 99 cents, so that's what I made it, and for the paperback, they allowed me to go down to $5.38, so that's what I made it. That was the printing costs. So I made it as cheap as possible, so those of you that still want the book, you can go ahead and get it there on Amazon. And for those of you that have Kindle Unlimited, of course, it is free because you're paying for that membership. One of the other things I did today was work a lot on the options course and just trying to get more and more material filmed. We're up to about 50 hours on that course, give or take about 5 to 7 hours. And that course is really starting to add up in time and lessons. It's going to be a multi-course so there's going to be multiple segments to that course, and we'll probably have it released by about August time, because by the time we finish the editing, the study guide, sales pages, and the manufacturing, it's going to take a little while. We still have to wrap up one of the diagonal sections here, which is actually one of the things that I'll be using here in the example to go through this lesson on the VIX. So that's what we're going to go over today, and let's get into the lesson. So here you can see I have a base sample account, and you can see Apple, Google, Netflix, SPX. So these are just some baseline positions in a simulated fake paper money account. And when you're trading options, the VIX is normally the tool or utility that drives these option prices, but it can be used to also trade stocks. So if you don't trade options, you stay with me here, and I'm going to share with you some insight as well about how you can use it for stocks. So first off, before getting into the VIX and how you can use it, let's talk about how it really functions or behaves, or what does it really tell you. It's basically a fear indicator. If you haven't heard that before, it's the amount of puts that are basically purchased on the S&P 500. So if I take the S&P 500 over here, you can see the S&P. As it moves higher to the upside, people are less scared and they don't feel like they need puts. And puts are basically insurance on your stock. So for those of you that have health insurance or have car insurance or any kind of insurance, even if you're the same age as another person, if you have pre-existing conditions, your health insurance premiums might be much more. And that is simply because you are riskier. If you're smoking, if you've been smoking, if you've had health problems, heart conditions, surgeries, those kinds of things, your insurance premiums are going to skyrocket even if you're the same age as another person. And this is what the VIX kind of tells you, is the risk factor of the market. Now, the risk factor is determined based on the volatility and how a stock can snap. It can snap to the upside or the downside. But typically, as we know and understand, stocks typically snap down. They don't usually crash to the upside. They usually crash down. If they crash, they usually don't crash to the upside. And that is simply because fear is stronger than greed. And it's just the natural cause of energy, okay? Gravity. It's natural. Gravity will pull things towards the center of the earth. So here, in the same way, if you're pushing against gravity to support a stock for it to continue to go higher, you have to push it higher. How do you push it higher? By buying that stock. You're pushing it with your money. And you need more and more money all the time to keep pushing it higher. That's a lot of energy, okay? It's all a game of energy. So here, as stocks continue to go higher, and you can look here on this diagram with the VIX CBOE volatility index that I put here at the bottom of TC2000, and you can go ahead and add that by clicking the little plus at the top. And then you can type in the VIX, and then you go to the market volatility index. So when you have that up, you can see that anytime we have a little sell-off, the VIX spikes up. And that VIX, once it spikes, you can see that we get a little high and low range. It's kind of like looking at the McClellan oscillator, and you can see that you have a range at the high end, overbought and oversold range. And you're just basically drawing the upper band and the lower band of that. And then it gives you an idea of overbought or oversold, just like if you use the RSI indicators. For me, simply looking at the VIX will tell me how volatile, if you go to VIX and then right over here, CBOE, gives you an idea of some of the high and low ranges. And I can go ahead and delete some of these drawings. If you back up and backtrack in history, you will see that kind of the lows are right around that $12 range. The really ultimate high is in that 2009 level, which you can see was hitting those highs in the $90 range. But overall, the average highs are kind of in the $30 range, or 30-point range, really. So those are kind of the higher upper band levels. And more recently, if you want to get a little tighter, you can say it's about the 20 level, which right now at the current level, we're hitting kind of that $20 level, and now we're pulling back a little bit. So you see we had a little pop in the VIX. So what does this tell me? Well, anytime the market, if you go to the S&P, the market tends to sell off, that VIX tends to spike. And if you go back and you take a look at this on the monthly chart over here, you can see that when we had these pullbacks in 2000, 2001, 2002, 2003, we had higher VIX to spiking. Okay, when we had the upward motion in 2004, 2005, 2006, 2007, the VIX went down. We were right around the 15 point on the VIX. As we went into 2008, 2009, the VIX spiked up again, and then we had about an 80, 90 point on the VIX. A lot of fear during that time frame. Now, since 2009, we've kind of been going to the upside, and that's when you can see the VIX was slowly starting to calm down. But with every pullback, people were nervous because of that 2000 and 2008 year of that pullback. So they were worried that it would repeat and continue moving to the downside. And that's why you will see the VIX spike a little higher as we get these pullbacks, just like we had in 2011, 2012. And now if you look a little more intraday or more on the daily charts, you can see that anytime we get major sell-offs, that VIX will pop, which basically dictates the price of the puts and the calls. So if we go into our trade pricings, you can see the price here between the bid and the ask. The prices of these will shoot up as that VIX pops higher. So the higher the VIX, the more expensive this bid and ask price. So as you get higher prices, it really allows you to do much more in trading. Now, for beginner investors, they hate a high VIX. They hate a high VIX because things are more expensive. It's more expensive to buy put or calls, and the market whips around. For example, if you look on today's action and we just look on the intraday, you can see we had a major sell-off. Okay, we had a sell-off pretty good. It was about, I'd say, 14, 15, 20-point sell-off. And then we popped back higher into positive territory. And that's what you'll get in these volatile market environments. When the VIX is high, you get whipsaw action. And many beginners don't like this because the market's not calm. It feels like it's behaving irrationally, but the professionals love this. Why is that? Well, because now you get movement. You get movement in the stocks, and you can be buying stocks at the lower prices, and then they whip back up, and you can get out of those positions and you make money for the day as much as you would maybe in 2-3 weeks as the market was heading higher. So that's one of the reasons why these professionals love volatility. Now, when you look at this, one of the reasons this happens is, again, because the market typically crashes up rather than crashing down. So backing up again on our monthly chart, how long did it take from 2002 to 2008 to go up? It took about 5.3 years. However, when we went down, how long did it take to go down? About 1.5 years. So that market, when it goes up, it takes a lot more energy to go up than it does to go down. So as I emphasized earlier, markets will typically crash down, not crash up. It takes a lot more energy to push a market higher. You have to keep putting money into a stock to keep it holding up and keep pushing it higher and higher. Whereas for selling, you're just selling the trigger of what you already have. Okay, so typically markets will crash down rather than crash up. And when they crash down, the insurance premium of that becomes more expensive. There's more risk. Think of this like when you go to your insurance company to get health insurance. If you tell them that you're a smoker, you've had heart problems, you've had diseases, you were exposed to biochemicals, there's a lot of problems that you have on your health. And in that case, your insurance premium is going to go higher. And this is what happens here on these option prices and contracts, whether you do it on the put side or even if you do it on the call side. So no matter where you look, put or call, the insurance prices and the premiums on these puts and calls becomes more expensive. Now, this is a good thing if you're a seller of options, not a good thing if you're a buyer of options. But most professionals, they're normally selling option premiums. Now, for us, when we're trading stocks, this also tells us the volatility. So the higher the VIX, right now we're at 19.37, the higher the VIX, the more whipsaw action we get. So for you, even if you're not a trader of options, a higher VIX will tell you how much whipsaw action you're going to get. And this is good to use when you're setting stops. So if you're looking to trade a stock, you want to give it a little more room if you have a higher VIX. And that is because you'll get more whipsaw action within those stocks. It doesn't matter that the VIX is based on the S&P 500 because it's going to affect other stocks as well. So for example, if you're trading like an Apple right here and you see that the VIX is higher, okay, you might want to give yourself a little more cushion to the downside or the upside on your stop. So if normally you're trading like a Apple, Netflix, a Lowe's, anything like that, and you're normally giving yourself, let's just say 25 cents or 50 cents or $1 on the downside for that stock to break, then when you have a higher VIX, you might want to give yourself a little more room. You might want to give it $2 or $3. And that is because you'll get that extra whipsaw action and the manipulation. Remember, the VIX is related to volatility, not direction. So volatility is the spread, the price spread between the open and the close. So the larger the price spread, the more volatile things get. The more whipping around you get, the higher the VIX. And here, if we have a VIX and you go to this chart, that higher that VIX price, the more whipsaw action you're going to get. So for you, if you're trading stocks, okay, if you're trading a stock, doesn't matter what it is, we'll just use Lowe's right now as an example. If you were looking to get into Lowe's right here on this breakout, and you notice you had a low VIX, you can have a little bit of a tighter stop, okay, because the VIX is low. So here, just 3 days before that stock broke lower, you can see that VIX popping up to the 17 price range. Now, you could not have predicted this earlier, that you would have had, the VIX popping in the future. So all you can do is, if you're in the position, you can reduce your risk, or number two, widen that stop. Now, I'm not saying that Lowe's is going to continue moving higher. What I'm saying is that you'll get this whipsaw action that draws down past these support levels only to whip back up because that VIX is higher. That's what it does on the manipulation side. If you look at Netflix here, same thing. We've had this little whipsaw action. Stock whips down, okay, retest this support level, then what it'll do is take a look here on June 13th, 2016. It'll whip to the upside only to come back later, okay? And now it's trying to rebuild that support, and then it's trying to pop to that upside again. So you'll get some weird whipsaw action in these stocks as that VIX is high, because a lot of it is emotional trading. You'll get whipped around when that VIX is high because that fear is kicking in. So what do? Well, again, you can have a little bit of a larger stop on your stock if you're trading stocks. The other thing you could do is reduce your position size if you have a higher VIX and you've been long in position. So for example, if you've been trading, let's just say the WYNN, W-Y-N-N, and you've been trading it to the upside since this breakout in February and March, and you see a higher VIX and the VIX is popping, you could reduce your position just slightly when that VIX starts increasing, meaning take some of the profits off into strength. Take your profits, put them in your pocket, and then, go ahead and allow the rest of that stock to run or come back to your stop. But that way, at least you've taken some profits off because it can whip around much more. And that way you're seeing your profits, and it's just going to, fake you out or psych you out. And that's where a lot of people get really nervous. So if you're the type of person or trader that when you're in a position and you're scared from the whipsaw action on the day-to-day action, just like here, we'll take a look on these current positions, these sample trades that I have. If you're worried about a position, for example, that's down $30 or a position that's here down $100 here on Netflix, if you're worried about these kinds of actions, then you need to set a wider stop or trade lighter, or you need to trade in lighter volatility environments, but you can't really control those environments. So you have to trade what's out in front of you. So what you could do is reduce your position size and take profits into strength, or just simply reduce your position size, or go ahead and widen your stop. So those are some of the things that you could do. Now, normally, I don't like to personally shift my stops, my stopping points, because those are my key places that I'm watching. But in higher volatility environments, sometimes this is necessary. Now, normally, if it's a fearful problem, you probably need to reduce your position size because you're trading too large for your experience. But in general, volatility will get you those numbers to whip around even more. If you have less volatility, it'll move very little on a day-to-day basis. And in that case, you get more greedy and saying, hey, well, I wish my account would grow a lot faster. So those are some of the key points if you're trading stocks regarding the VIX. Now, what about if you're trading options or you're looking to trade options? Well, here in this example, when we're trading options, we want to be a net seller of options. And typically when you sell options, you want higher prices, just like when you sell anything. So if I'm selling a pair of shoes, I want to sell them for as much as possible. Now here, option prices are dictated in part by the volatility. So the more volatile things are, the more I can sell these option premiums for. So if I'm selling, let's just say I'm selling a vertical, and I'll go ahead and analyze this trade. And let me just hide some of these positions so we don't need to see them. And if I'm selling this vertical like this, what I'm looking at is the current price. And the price that I'm selling this vertical at is telling me that I can sell this for $220 if I look at the lower left over here. And it shows me $220 is what I'm selling my vertical at. That is also the credit here. Remember, one contract refers to 100 shares. So that's $220 is why it comes up with that number. Now, the green line here, if you're looking at the video, the green line refers to the line at expiration. So right away, we wouldn't make $220. And the white line is the current today's line, profit and picture line. Now, as time moves forward, this line, this white line, slowly gets closer to the green line due to the decay, the theta decay. And that's what allows me to collect my premium. And at expiration, boom, I would make my $220. So how does the VIX play a role in this? Well, right now, with the VIX being right around 1920 points. When it was at 22 earlier this week, I probably could have sold this exact same position, this vertical, for probably around 260, maybe even higher, maybe around 270, 280. So I could have made $280 per contract. Of course, if I did 2 contracts, it'd be 560. Let's just stick to 1 contract to make it easier. But with 1 contract, I could have made probably $280 if I sold it with a high VIX. Now, as the VIX is slowly coming down, I'm only able to get about 220. If that VIX continues to move lower, then it drives the prices of options lower because the insurance, the risk is not there. So the insurance, nobody wants to buy insurance, then how can I sell it? So I'm trying to get rid of it. If I can make it cheaper, that allows me to get rid of it. So maybe I could get $180 on that insurance, which would be $1.80. Multiply times 100 gives you your $180. So that's the thing, is when you're a net seller of option premium, just like we are selling option premium in the option business, by having a higher VIX allows you to sell options for more money, and therefore you collect more premium on the options. And this is great, especially for if you're selling verticals like we just did, or you can do, if you do the S&P, you can also sell things like an iron condor. So if you go ahead and we analyze this trade, it's basically 2 verticals on both sides. So what we can do is go all the way over here, and let's just say I move some of these strike prices. And now, as you move these strike prices, you'll get kind of a iron condor that'll look maybe more like this. And now, this one, you can make about 450 on that. Now, if we had a lower volatility, again, I would probably only be able to make, let's just say, $360 on it. Now, I could compensate for that, and I could go a little wider on some of these, meaning drop down some of the legs, because that's just the difference between these option contracts, and I could drop this other leg down, but still, I'm paying and I'm getting less money in a lower volatility environment. With a higher volatility, these trades are fantastic to put on. Such as the iron condors, the butterflies, you also have the verticals. But when you look at calendars, calendars are not the best trades to put on in a high volatility environment, because when you look at a calendar, and here's a calendar, by the way, when you take a look at a calendar, if you look at the calendar, these are not the best trades to put on during a high volatility environment. And that is because this trade is a positive Vega trade, or a positive volatility trade, because you're actually a net buyer of options. Even though you're a selling option premium, because this is the business you're in. Any business is selling things, okay? So even if you're trading stocks, you're buying them, then you're selling them, or you're selling them, then you're buying them at a lower price if you're going short. If you're selling iron condors, you're a net seller. Now, with a calendar here, you're still a seller, but overall, you're technically a net buyer. And you can see this is a green bar rather before you saw them red. And that is because overall, the amount of days that we're buying is actually on a buy side. So we're selling, the way the calendars work is you're selling the 28-day option contracts, and you're buying the 63-day contracts. And how is option prices determined? Well, by the intrinsic and extrinsic value, which is basically if they're worth anything. That's all that means, is if they're in the money or out of the money. So if those are equal, okay, if we're trading the 2,080 strike price, then that has no relevance. Then if we go ahead and look at the volatility, well, the volatility is going to be 48 on the 28-day. And then over here, we've got about the 48 point as well, because volatility is the same today because I'm buying them all today. But the difference here is I'm spreading the time difference. I'm selling 28 days, but I'm buying 63 days worth of premium. So because the difference here is I'm actually buying more time, I'm actually a net buyer of options. So this type of trade, you actually have to close it out. You can't just let it expire, because once you go through July and July expires, August starts kicking in, you're actually going to be losing money day in and day out, rather than when you're doing an iron condor, for example. If I just sell an iron condor or a vertical, any one of these trades, they all expire in 1 month, and you can see it's red there. So as I do a iron condor, again, we can spread these out, and when you spread them out, you get a little better view of what an iron condor will look like. And with these trades, you can allow them to expire completely. Okay, you can allow them just to sit and expire, but you're just selling. You're selling one in the same month, the 2180, but you're buying the 2210. So if we look at this and we just go to, let's just say 111 strike prices. So I'm selling, which one am I selling? I'm selling the 2180 and buying the 2210. I'm selling 2110. So I'm selling the inner one right here, let's say 2110 at $18, and then I'm buying back another one at, let's say, $4 or $6. So the difference between those is what I'm making. So I'm selling one that's more expensive, buying protection there. Whereas with the calendar, it works a little bit differently. So with the calendar, you're buying more time. You're actually selling. If we tighten this up, let's just say 6 strike prices. If we tighten this up and you go and you sell this one at 34, you're actually buying the 50. So you're buying something more expensive. Now, the reason this works out, if you're still wondering, is because the one in July expires before the one in August. So because they're at the same strike price, because the volatility is currently the same as we put on the trade. The difference is the days. So even though that this one is more expensive in August, it's $50, whereas the one in July is $34. We sell $34 of premium, but we pay $50 of premium. So what we need to do is, once this one gets to pretty much zero, or as close as we can get it, then we go ahead and close the other trade out. And this is kind of what's going on with some of these diagonals that I have. Like, for example, Apple. If you take a look at Apple, I've done actually a diagonal on this one. And this one with the diagonal, they're a little more rotated. But you can see that we have a July and an August, and we have a few contracts. This is a bearish position. And as time decays, it goes closer and closer to that line. Now, when you put this on, it's good to do these in a low VIX environment, because this is a diagonal. It's multi-month. And I put this on before the VIX popped. But if the VIX was high right now, I wouldn't put this trade on. Instead, I would put on more of the iron condor, more of a butterfly, more of a vertical. Those are the types of trades I would put on a higher VIX environment. And that is simply because the option prices skyrocket as that VIX pops. So I hope this makes sense regarding the VIX. It's really just dictates the, number one is it's a fear dictator. Do I trade the VIX on its own? For example, you could trade the VIX on its own as contracts. No, I don't. I don't trade the VIX. I don't use it as a hedge or anything like that. And that is simply because I don't trade fear. Why would you trade an emotion? It doesn't make sense to me. There's no point for that. And instead, what I'll do is I'll look at the VIX and I'll look at the contracts. Where are people buying the contracts or selling the contracts? So here you can see the activity. Where is that activity? And by looking at the VIX, it just gives you a gauge or an idea to how much whipsaw action you get in the market. And if you're looking at the S&P, if you're looking at it on a day-to-day basis, the higher the VIX, the more whipsaw action you'll get. If the VIX is low, you typically will just get little action to the upside, little movements, but you don't usually get a lot of whipsaw action. So that is just because there's less fear in the market. Now, there is a common phrase that some people think about: when the VIX is low, look out below, because then the market is going to sell off. And that is because they work inverse. So when the market is high, the VIX is low. When the market starts its sell-off and the VIX is high, the market is low. And they work oftentimes in opposite. Doesn't always work out, but it's really just a dictation of those put contracts, how much insurance people are buying to protect themselves. And with Brexit being around the corner, and all these uncertainties that they keep talking about with the Fed, the Yellen, all this stuff, the presidential campaign and race, there's a lot of uncertainties that happen. And, when you look at the overall market, I mean, to me, when I look at this market, I would think it's quite overextended. Can it still go higher? Yeah, we can. And, we were pushing here on air for multiple weeks here. We were just going higher and higher and higher. And it was actually brutal to my account for a little while. And then once we got this rollover effect happening, everything kicked in real easily, because within just one day right here, look at that VIX popping, because we went from a VIX of about 14 and we popped to about a 17 within one day. That one day on June 10th, 2016, that one day took out, if you bring this day across, this is why I like shorting much more than going long sometimes, depending on the environment. Oftentimes, I like going long because you can make much more money going long to the upside. But when things are overinflated like this, overpriced, it's the reward is better to the downside. So for me, normally I like to go long. In retrospect, I like going long more often. But when things are so inflated, I'd rather go short, because you just make money much quicker. Because here, you're treading higher. But then in one day, it wipes out how many days of gains? 13 days of gains you wipe out in that 1 or 2 days. And, those are just some things to think about, is that, you don't have to be a bull or bear. It's just about doing the trades appropriately for your account. Normally, in a normal professional environment, you'll make more money going to the upside. And that is because stocks can go to the upside, to the moon, to infinity. To the short side, they can do pullbacks and things like that, but they don't usually go down to zero. So most of the time, going long is the best or the better alternative. But when you do have those crashes that start coming in, especially if you start looking at these monthlies, they are painful for a lot of people if you're on that wrong side of the trade. So, and sometimes once you start seeing this VIX pop, it'll give you a little indicator of things could be happening. So you can see here in 2007 to 2008 how the VIX started to pop a little bit at that 38 point level, and then we had a further major sell-off, and then the VIX really shot up. So it'll give you a little indication when that VIX is popping. Sometimes the money managers, they know better. They're protecting themselves against something. So watching it at those different levels will give you some gauge or insight to what protection is being purchased. And it really gives you a little clue and insight to how much whipsaw action you'll get. Now, if you're trading stocks, remember, reduce your position. You can go ahead and take profits into strength if you were profitable, or you're going to need to give a little more room for that whipsaw action. You'll have to stomach those kinds of things. Or if you can't do it, simply get out of your position. You can put it on a little bit later. That is if you're learning how to still trade and you don't want to be in those volatile environments. Now, if you're trading options, when the VIX is low, great to put on things like calendars, diagonals, those types of trades, things that are more bullish verticals, because it's cheaper on the premiums. If you're a net seller, it's better to do them when they are the VIX is high. So when the VIX is high, you want to sell that premium, just like when the VIX is here at the 90. You want to be a seller because people want them. And if you're giving the market what it wants, you're able to capture on that. And it's really kind of a contrarian kind of thing to do, but this is the way the business works, is you're giving people what they want. And if they want to buy put options, then if you're a seller, it works out better in your favor. So I hope this gives you some insight to the fear indicator, the VIX, how I use it. Really, for me, it just comes down to looking at how much volatility is going to be in the marketplace. And the higher the VIX we professional traders, we like higher VIXs because it whips the market around, and it allows you to sell higher price premium, and it also allows you to capture bigger runs because the market will dip down and then it'll pop and spike up all in one day. You might get a 20, 30 point move on the S&P. So it's really great for professionals, but for beginners, they usually don't like it. And that is because they don't understand the movements. It may seem erratic, it may seem choppy, whipsawed, that kind of thing. But if you learn to embrace it, it's going to be one of your favorite things when you start seeing volatility, because you'll be able to make a lot more cash on the downside in a shorter period of time. Because again, markets typically will crash down or move down much faster than they move up. They can move higher much longer time period, but as far as time goes, you can make much more money in a shorter period of time if you're going to the downside. So thanks for joining me today. Hope you enjoyed the lesson. Keep your eyes peeled for some other great content coming up. And if you want to sign up to the newsletter, click the button right here on this screen. Of course, you can also sign up to my free trial to the critical charts. And don't forget to subscribe on YouTube. Enjoy your weekend and time with the family. I'll probably do a little bit of gardening here out in the back. We got some cucumber, we got some zucchini, some bean plants, some tomatoes, that kind of stuff out in the back, and it just gives you some nice fresh produce to eat and enjoy during these nice summer months. So enjoy the weekend, make it a great one, and remember to do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.